Hello and welcome to Fidelity Connects. I'm Glenn Davidson. It's the start of a new trading week and U.S. equity markets have retreated following a 2-week hot streak. On deck this week, big tech is set to report their Q4 earnings and the Federal Reserve will hold its first policy meeting of the year. What key trends should investors look for in Q4 results? And how might the Fed's first policy meeting of the year set the tone for the markets in 2025? Well, joining me now to unpack the macro themes on his radar and to set you up for the trading week ahead is Fidelity Director of Global Macro from Santa Barbara, Jurrien Timmer. Jurrien, welcome.
Good morning, Glenn. Nice to see you.
And I see you have bicycles behind you. You can ride those, unlike us here in Canada who are freezing. So good for you for being in Santa Barbara. Jurrien, we should start with what's happened since the last webcast you did, which was a week ago. There's been a chaotic stream of consciousness on a 24/7 standpoint. First week in power for Donald Trump. Give us your overview of what's happened in this last 7 days.
Yes, well, as he had promised, it's all gas, no brake. It's interesting. I've been watching him. Of course, I was in Aruba last week with my parents for their annual little pilgrimage back from Holland to Aruba. And so it's our little tradition that after dinner, which I tend to cook, we sit, and watch a little Dutch TV news and some of the current event type of talk shows. And that happened right, during the inauguration and in the days that followed. And it's just really interesting to see that from a European perspective. But no matter what you think of the guy, he's got an energy and I guess a clarity of purpose, whether we agree with that purpose or not. That is, it's pretty impressive. I mean, he is just full speed ahead. And I think the take I got from sort of the European commentators, if you will, is that, boy, we better play along or we're going to be left behind in the dust because this America First policy from a country that is really very large and powerful is something that can steamroll over a bunch of other countries. And we saw an example of that with Colombia. It's like, if you're not taking your migrants back, we're going to put tariffs on you. And that they did. And then Colombia walked back and said, okay, we'll take them. And that, I think, is the kind of policy we're going to see in many places. And obviously you all are potentially on the receiving end of that as well. And then, having those tech billionaires in the room at an inauguration, that was a pretty clear message. I think that, we're in the age of industrial policy. And of course, these days, that's somewhat, tech related. And having all those guys in the room, I think was there to send a message that, we're going to make things happen and we're going to work with the private industries to do that. And as long as you're his friend, I think you're going to work with him. And I think that's that. I'm sure it will end badly at some point in some way, but it's that full speed ahead sense, I think, is certainly where we're starting.
Tariffs are an interesting penalty card that Trump seems to have to throw at different economies. He's talked a lot about Mexico, China, and Canada. And then Colombia yesterday came out of the blue. It obviously, as you mentioned, changed things in the favor of the United States to allow the deportees to end up back in Colombia. But do you think that's always going to be the main negotiating card, if you will, for Trump?
I think so, and you put it very, very well that it's like a penalty card, and so he will be, let's do business, and if you don't, I'm going to put tariffs on you. And so, and again, listening to these Dutch shows, it was like, okay, we do have tariffs on products, especially like cars that come into Europe. We should start thinking about where can we reduce those tariffs in case, he comes with that big stick to start attacking us. But yeah, I mean, I think Trump, he knows the power of it. And I don't know that that these tariffs will be anything more than just getting his way. And again, unfettered power, you worry about where the lines and the limits are. And that's certainly true sort of on the geopolitical stage, but I think it's true just generally speaking in terms of the economy and monetary policy and interest rates. I mean, the risk is that If everyone is, speaking from the same hymnal, if you will, in Washington, and I think they all are because all of his cabinet members have been carefully selected to never disagree with him, right? Remember Trump 45, his first term, he had a lot of very rational people in there who ended up not agreeing, and they all became enemies and left. And so this time, they're all loyalists, and so that creates the risk that there's an overreach at some point. And I don't mean specifically on the geopolitical side, but also just on the economic side, that they just want to fire this economy up, and that we're going to pay for it at the end with higher inflation, maybe a tighter Fed, and a higher term premium. And so I think more in those terms, that if you don't have the checks and balances as much as we used to. We have some, right? There are some sober people in the Senate, even Republicans, who are just not going to go along with everything. But generally, this sort of unchecked power, this full speed ahead, it could have unintended consequences. And I think, economically speaking, they could materialize just on the Fed side, on the rate side. And imagine if Powell ends up feeling like he needs to raise rate because inflation is back at 4% or so. What he would hear, he would get an earful from the president if he ever wanted to do that. So I think about those sort of iterations as we move forward, even though it's a little early because it's only been 1 week, of course.
There's a lot to unpack from what you just said. And one of the things I think is the fact that because Trump had a non-sequential presidential term, it allowed him and his loyalists to retool over a longer period of time to come back quite differently than at 45. So it should be interesting to see.
Yeah, and remember the first time around in 2016, no one expected him to get elected, and probably he didn't expect to get elected, and then he did get elected, and he was not prepared, right? They had, I mean, the Treasury was understaffed for months. Like they didn't even have a Treasury secretary for a while. And so it was sort of, a very happenstance start in the first term. It was kind of chaotic. This time, boy, are they ready. I mean, they were doing things before, like a day after election day, they were already starting to make phone calls and everything. So this is quite a different start than the first one.
Actually, I think they started doing stuff in November. So this was very different. The Buffett indicator being at an all-time high. And it reminds me of an interview you and I did in the chart room back in July of last year, in the infamous chart room about what's going on with the chart room, the history and so on. But around the corner from where we stood was the infamous chart of market sentiment. The magazine covers, and if for any of our viewers who have been down to see this, it's a wonderful chart. It's got what the market sentiment was at particular times in the market, and generally when everything looked positive, the market went the opposite direction, and vice versa. It seems like right now, Jurrien, everything's very, very positive, except for today perhaps. Very, very positive in everything that everybody reads. Do you feel nervous about that? And when you think of that chart in particular?
Yeah, and we will talk about DeepSeek in a moment. But yeah, why don't we pull up slide 7, just the valuation side. So the viewer asked about the Buffett indicator, which is the market cap of the stock market in the U.S. As a ratio to GDP. And I'm not a huge fan of that indicator simply because you think about the really big companies in the U.S., they're not really, I mean, they are U.S. companies, but they are global companies, right? So as they become more and more global, as the S&P becomes more global, comparing it to the U.S. GDP has its limits. But having said that, there is no question that valuations are high. We're now trading at a 26 multiple to trailing earnings, and on an equal weighted basis, we're trading at 20. And if we go to slide 8, you can see that not only in 2024, but in 2023, the valuation side of the market's return, really amplified what was a decent earnings recovery, and we are ongoing with that. Earnings season is underway. But you see the orange bars is earnings growth, the pink bars is the change in valuation. Those two things together, plus the dividend yield, is what the total return for any stock market is. And you can see that historically, generally when earnings are zigging, the valuation is zagging because price always anticipates earnings, so the price tends to move in advance of earnings. But the last 2 years we had an earnings cycle coming up. Earnings growth for 2024 is at 10%, and for 25 it looks like it's going to be about 12%. So that part of the story is really good, but that 10% has been greatly amplified by another 20% increase in the valuation. And to me, after 2 years of that, it's going to be really hard to repeat that in 2025, especially if we get some pressure from rates, right? So I think the Fed is really not going to be cutting rates anymore. They are meeting this month. I don't see them giving another 25. We're at 4 3/8 right now. A neutral rate I see as around 4. So the Fed could cut one more time, but I don't think it really needs to be in a hurry. This economy does not hang on by a thread waiting for the Fed to cut rates. I think what's happening at the long end of the curve, and that's slide 6, is a lot more important, because at the long end of the curve, we have a rising term premium, and term premium is basically the risk premium for long bonds. And the term premium should be positive. Risk premia should always be positive. But in the era of QE and zero interest rate policy, the term premium was pushed down, and that was the entire point of those policies, is to push that risk premium down so that investors would go somewhere else and buy riskier assets, which they did. So my sense is that yields do have upward risk towards 5, maybe even higher, and that I think will knock the PE down a couple of notches. Which is not to say that the market will fall, because earnings are growing. And actually, if we go to slide 5, you can see that as we are now entering the second week of earnings season, slide 5, sorry, slide 9, my bad. That as we are entering now the second or third week of earnings season, you see that growth rate that's expected is at 8%. And typically by now we're starting to see that bounce. So my guess is we'll have double-digit earnings growth. And if we go to the next slide, we can see that the squiggles chart with the calendar year estimates, that's showing some nice sequential upward moves. So the earnings per share in 2024 looks like it's going to settle in at $239. For 25, it's 260. For 26, it's 311. Those numbers will probably come down because there's generally a downward drift. But still, that would be a nice trajectory, and it shows that we're probably in a pretty good sustainable earnings growth cycle. And to me, the main risk, right? We think about known unknowns, right? So tariffs is one known unknown, immigration policy is another, and interest rates, of course, is another one. And again, I'm not worried about the Fed so much, the short end, but I'm worried more about the long end, that in an era of fiscal dominance, we're going to see a rising term premium. And so that's my take on earnings. But just back to the question on the Buffett indicator for a moment. I think the reason the Buffett indicator hasn't really worked as well is one, what I mentioned earlier about it being the market being more global these days, but also what the Buffett indicator shows is what my other charts also show, and that is that profit margins are high, right? So the share of earnings to GDP is rising, and therefore the market value to GDP is rising. So that rise, part of it is valuation, but part of it is that companies are just much better at generating earnings and operating margins. And I think that is an aspect that gets lost in the Buffett indicator, and that's why I don't have it in my deck on a weekly basis to show.
Fair enough. And overall market sentiment?
So sentiment was after the election last year, it really shot up, right? I don't have the chart in front of me, but if you look at fund flows, ETF flows, you look at investor sentiment surveys, they all shot up. So it was this sort of euphoria, maybe not euphoria is maybe not the good word, but there was a sense of, okay, we had a decisive election. It's a pro-growth administration. It's a pro-crypto administration. We're going to get animal spirits. We're going to get earnings growth. We're going to get less regulation. We're going to get extension of tax cuts or them made permanent. And so what obviously always happens is you buy the rumor and then maybe you sell the news, and that's actually what ended up happening. So in November and the first part of December, you saw this big swelling up of optimism in the markets. And then the second half of December, it actually kind of started to crumble. So Santa actually ended up not coming to rescue the markets. And then, of course, the first few weeks of January, the momentum picked up again. And now, now today we're dealing with the whole story in AI, where and just in case you're not familiar in the audience, obviously this has been a boom for the Magnificent Seven. We all know that story. And actually, if we pull up slide 4, you can see sort of the dominance of the Mag 7 relative to the equal weighted S&P index. The purple bars is the 3-month excess return. So the Mag 7 outperformed the broader market by 22 percentage points over the last 3 months. So that's a pretty significant period of outperformance. And so now you have a disruptor coming in, a Chinese AI company that supposedly, and again, this news is really just breaking, so we don't really know how all of this is going to play out. But now you have this Chinese AI company that supposedly does everything that ChatGPT and OpenAI does, but with a fraction of the computing power, and that's putting a question on whether we actually need all of this infrastructure, all of this hardware, all of this electrical power that the whole Mag 7 trade is based on. Maybe we can do it with less, and this is one of these unknown unknowns. Like nobody saw this coming, right? We just assumed that we have to buy a lot of NVIDIA chips, and then we build out the infrastructure. So again, I'm not an expert. I don't know what else is coming in the news on this, but that's why the markets are down. And it's interesting that my colleagues and I often are talking about rotation and should we be buying non-US stocks because they're so much cheaper? And can the market really rally if the Mag 7 are going down? And today we're getting a little bit of a snapshot on that because the S&P is down, I think, 1.7% last time I checked. The S&P equal weighted index is down a lot less. And of course, the Mag 7 is down like 2.5%. But the MSCI EFA index is actually up. And so to me, that's a really good lesson or precursor that if we ever did get an absolute decline in the Mag 7, probably the market's not going to be able to go up. But the rest of the world that has been so left behind with this AI trade will do a lot better, at least in relative terms, just because it hasn't really gone up and it's not expensive. The MSCI ex-US index is a 13 PE, whereas the US is a 23 PE. So it's an interesting lesson or hint of what might happen at some point if the Mag 7 really loses its momentum.
Glad that you touched on it. It does show, and perhaps it's a deep fake, but it does show the vulnerability with the valuations. The investors are worried, and any little thing that comes out, you see that knee-jerk reaction that we've just seen.
Yeah, and we saw this last year in July when that yen carry trade got unwound, right? So that showed that the Mag 7 was a very crowded trade at the time. So in other words, investors were borrowing yen to buy the AI stocks. And then the yen carry trade gets unwound. You have big margin calls. And that was a time, it only lasted a few days, but the VIX went to like 62 or something. And for those few days, the Mag 7 went down and it took the market down with it. And that is an important reminder that when stocks get that top heavy, and the Mag 7 is about a third of the market, if the rotation ever happens where everything else outperforms, it's likely to be in a down market and not in an up market, just because of the math of these very, very big stocks, that if they ever get sold, they will take the market down with it, which, for investors, as long as you're have a broad exposure in other markets, in other countries, in other regions, in other styles like value, you will do well, but you'll do well on a relative basis more so than on an absolute basis.
Couple of questions about crypto for you. I know you've done a number of interesting reports on that and always have some comments. So first off would be interesting that when the focus that's been on Bitcoin and the focus that's been therefore on Trump and his openness to what Bitcoin and crypto is all about. And then a week and a half ago, a Trump and Melania coin came out. They claimed that had nothing to do with the crypto market. It's just whatever they said. But that's been a distraction and a concern to people who have been focused on Bitcoin. So question one is your thoughts on that area. Second is the correlation, because, for example, today we see a sell-off in the NASDAQ. You see an equal sell-off, not by percentage, but you see a sell-off in Bitcoin as well. And you were just talking about diversification. It seems that some people may have gone to crypto as a diversifier, but it really has a high correlation to technology. So thoughts on those 2 points?
Yeah, so it's a great question. Let's go to slide 14. So I love Bitcoin. That's not a secret, but I have to say that the dialogue in the crypto world just leaves me wondering sometimes, and especially among the Bitcoin maxis, right? So this is supposed to be anarchy money, right? It's like, we don't need Big Brother. We got our own money, but yet they're all begging Trump to put it in a strategic reserve, and it's like, people, please, so I roll my eyes a little bit at that, and I really don't see any reason why Bitcoin should be in a strategic reserve. The dollar's been not anchored to gold or anything else since 1971, and it has done just fine, right? So we're not some third world small country whose currency is getting destroyed by capital flows, and we need to prop it up by putting some Bitcoin in there. We don't have those issues with the US dollar. We're still the cleanest dirty shirt in the world. So I think that whole argument is kind of nonsense. But clearly, when you look a little bit broader about who voted for Trump, it was younger men of all stripes, right? Those were the people. Not to make a political comment, but those were the people that the Democrats sort of never catered to. It's like, like, we don't care about you. At least that was their sense. And so Trump was very smart at tapping into kind of the more like tech bro side, with Elon, the crypto side. And so I think he just, he likes to talk. He likes to reward his followers. And so that's why I think he said a lot of friendly things about crypto. But I don't know that it is particular about Bitcoin or anything else. I do think that they want to do some good stuff on the blockchain and making sure that that's all coming from the US, that we don't lose that innovation to other countries. I think that's a very good policy. But Bitcoin's already been regulated. I mean, we already have ETFs, but more should happen, right? Stable coins should be regulated, and I think that will happen.
Now, you've got something that you put out last week was on the January effect. I'm sure you have a chart on that, and I'm sure you have a chart on Super Bowls as well. Now that we know it's KC and Philly, let's talk about that. But let's go with January effect first.
So the January barometer, actually, I don't have the chart, but there's not much to show. But
okay.
The January barometer is an age-old indicator that says that if January is a good month, or even if the first 5 days of January are a good month, then the rest of the year is going to be good as well. And if it's a bad month, the rest of the year is going to be bad. A lot of people look at it. I've tested it backwards and forwards. And the very simple takeaway is that, yes, that's true, but it's true for every other month as well, right? So if February is good, then the next 11 months are going to be good. So all it really tells you is that markets tend to trend. I mean, markets are trending animals. And so if 1 month is up or down, chances are it's part of a trend, and then the following months will do the same. And so if you test a January barometer for any other month in the year, it shows you the same thing. So I would not worry too much or read too much into whatever happens in January. But you bring up a point, and that I did want to mention, is about trends and just having a good plan for investing. I did a study many years ago about dollar cost averaging, and I revisited that study, and we can pull up slide 16, about thinking about bonds role in a 60-40 portfolio, and what role gold might play. You mentioned the correlation of Bitcoin, and as you point out, um, Bitcoin can be uncorrelated sometimes, or it can be highly correlated. And I think that's just the nature of the duality of Bitcoin, that it is a store of value or an aspirational store of value. So it should be uncorrelated, but it's also a speculative asset that attracts hot money, and that makes it look like the Nasdaq. So it's not one or the other, but it's both, depending on what mood is playing out. But in this chart, I show, and I've got this little circle chart there, that's $100 invested every month for 10 years in a dollar cost averaging strategy, which is by far the best investing strategy anyone's ever come up with. So for the advisors in the audience, if they're talking to their customers, especially their customers' next generation, dollar cost averaging is what it's all about. And the batting average, so this goes from 1926 to now, 10-year increments, or 1 year, but 10-year DCAs with 1 year increments. And the batting average is that 90% of the time, in real terms, you would have made money. The best times were sort of in the 1940s, before that boom in the 50s. The worst times were in the mid 60s before the great inflation, and the late 90s before the dot-com bubble burst. And there's a lesson in there that the two things that will kill valuations are bubbles and inflation. Those are the two things. And that made me think about valuation. You mentioned the Buffett indicator. Very extreme valuations are very dangerous because starting points matter, right? So if you start investing when PEs are 40 or 50 or 100, that's going to take a long time to clear that hurdle of when earnings are going to do their thing. And the same with inflation. Inflation will kill valuations. And so that made me think about gold and also Bitcoin. I know we have only 2 minutes left, but if we go to the next slide, again, a 10-year DCA over time, this is shown in real terms. So $100 today, invested monthly for 10 years would be $5 in 1926. But again, you have a very good batting average. Your CAGR, your average return over that 10 years is about 4%, so really pretty good. If we go to the next slide, that is long-term government bonds. Now you see that you have very long periods where you didn't even reach break even. Like for instance, in the 1940s, which was a period of financial repression where the Fed held bond yields below the inflation rate. Obviously, you didn't make any money then. But then in the 1980s, when rates were coming down from the double digits, you would have done very, very well because, again, starting points matter. Now, let's show gold on the next chart. And gold is interesting because obviously gold for many years wasn't even tradable, right? That started in the 1970s. The batting average is pretty bad. It's like 40% of the time you make money in real terms, whereas for bonds it's 70% and for stocks it's 90%. But and then just for kicks, we'll put in the next slide, which shows Bitcoin starting in 2015. And of course, that's a very Bitcoin chart. So you see what happened there. But the punchline is if we go to the final slide, 21, this is a 60-30-10 portfolio, 60 stocks, 30 bonds, 10 gold. And then after 2015, out of that 10 gold, we put 3% in Bitcoin. Now, and if you extend the timeline from a 10-year DCA to a 20-year DCA, you get 100% batting average. And so that's not investment advice, but my point is that gold seems to be a very good hedge, not necessarily against stocks, but against bonds. And they do well just when you need it most, when you're sitting in bonds. So maybe as we go forward and we look at what happens to the 60-40 paradigm in this new world of fiscal dominance and maybe higher inflation and a higher term premium, to me, this is a good place to start looking.
Jurrien, I don't know where you come up with those graphics, but they're getting more and more interesting as you produce them. Thank you for being with us. And as I think you know, every week there's going to be even more to talk about than there was in the past because of what's going on in the States, but all around the world. Thank you, Jurrien, and have a great day.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.